Hello and welcome to this video. We'll be covering the good old credit score. We'll be looking at what the definition is of this figure, how is it calculated, and most importantly, what factors tend to drive the overall score to an individual. The credit score on its own is just a number which indicates the credit quality of an individual. What this means is that the higher the score, the more likely someone will pay back their loan. Now, if we take an example where we have two individuals, Jack and Josh. Jack has a credit score of 650 and Josh has a score of 750. But what does this mean? Well, this would mean that Josh is seen to be better quality than Jack. So, if Josh and Jack borrowed money from the same bank, it would be expected that Josh is more likely to pay back compared to Jack. One key concept to know is that there isn't just one credit score that an individual has. Usually, if you have seen your own credit score, this would be from an institution known as a credit bureau. The credit bureau is an intermediate that collects credit data on individuals. But where do they get this data from? The most common source will be from financial institutions. If financial institutions have a relationship with a particular credit bureau, they provide data to the bureau on their own customers. The credit bureau would have a relationship with many financial institutions, so they wouldn't just be receiving data from one source. The bureau would then collate all this information to gain a more universal view of the credit quality of that customer. Example, if you have a credit card with Bank A mortgage with Bank B, and a phone contract with a phone company, you technically have a credit contract with three institutions. If the institutions have an agreement with the bureau, they would send information relating to your credit behaviour, most likely on a monthly basis. The bureau will then collate this information and send a summarised file back to each institution. If you then defaulted on your credit card, the other two institutions would be made aware of this default event, even though you have only defaulted on one of these products. Let's run through factors that can impact your score. The first factor is missed payments. If you've missed payments in the past, such as on your credit card, then this gives an indication that you're likely to miss payments on future products where you borrow. This is likely to reduce your credit score. The second factor relates to credit history. If you've never borrowed, you will have no credit history. Having no credit history will make it difficult for a lender to determine the ability for you to pay back a loan. In most cases, having no credit history can reduce your credit score. The third factor is financial stability. The definition of financial stability can vary between lenders, but one example would be having a mortgage. If you have a mortgage and up to date on payments, this gives an indication you have a steady income to cover the mortgage payments you have on that loan. Having evidence of being financially stable will most likely increase your credit score. The final factor relates to the internal data the lender has on you. If you are borrowing from a bank and you've had a long-standing relationship with that bank, or you have a large amount of savings, then they can use this information to determine whether you have a high credit quality or not. If you have a large amount of savings within a particular bank, or have had a long-standing relationship, this is likely going to increase your chances of being accepted for a loan. Now let's run through a scorecard, which is a method to derive a credit score. In a scorecard, you will have a list of all the factors that impact the credit score, and the magnitude that your score will change due to that factor. Now, let's start off with an example with Jack. Jack will start off a score with 500, and each factor will either increase or decrease his score. The first factor is the number of missed payments in the last year. If Jack has never missed a payment, he will get 100 points added to his score. The next factor is whether Jack has a mortgage or not. In this case, he does, so he has an additional 25 points added to his score. The final factor is the savings balance. If Jack has $1,000 worth of savings at the bank, he gets another 25 points added to his score. After you've ran through the scorecard, you can see that Jack's final score is 650.
Yay!
Now, each bank, credit rating agency or financial institution will have their own method to derive a credit score, and this is just one example. In addition to that, the variables they use to derive a credit score may differ to the ones in this example shown. Thank you very much for watching this video. I hope it's provided more insight into the properties related to a credit score.